All right, folks, let's get down to business. Let's finish off the lecture today, and then we'll just leave one more lecture to go. Yeah, right. What was that? I don't have pain. I'm enjoying myself. Okay. Yes. Okay. I actually like what I'm doing though. So I understand your pain though. I've been there. Right. Right. Yeah. You should like what you're doing, right? I'm one of the lucky ones. All right. All right. Let's get down to business, folks. Let's get down to business. I want to knock out both of these chapters. The second chapter is not that long, and it has to do with banking and crises, stuff that I've already talked about, so it's not too big of a challenge. There aren't like complicated models or anything of that sort. Just a bunch of terminology that will actually be useful to you to understand. So let's try to get through it. So again, we're talking about the relationship between inflation and unemployment and how in the short run it can be represented by this Phillips curve that captures a negative relationship between these two metrics. But in the long run, that relationship may not hold. So let's talk about that. So according to the Phillips curve implied trade-off, policymakers have a choice. They can choose to accept the price of high inflation in order to achieve low unemployment or vice versa. So that's what the Phillips curve implied, and up to the 1960s, that's sort of like was the conventional attitude that policymakers took with respect to these two phenomena. During the 1960s, many economists believed that this trade-off represented a real choice. This view was greatly altered by the later recognition that expected inflation affects the short-run Phillips curve. And again, that happens through employers and wages. If people expect prices to go up, then they will write into their employment contracts higher wages, which effectively raises prices. So in the short run, expectations often diverge from reality. But in the long run, any consistent rate of inflation will be reflected in expectations. So most macroeconomists believe that there is no long-run trade-off between unemployment and inflation. It's not possible to achieve lower unemployment in the long run by accepting higher inflation. So let's look at what that might look like as far as like our Phillips curve framework. So let's talk about the long-run Phillips curve. So suppose that the economy has in the past had a 0% inflation rate. So as far as like our short run Phillips curve, we're at the point where our unemployment rate is at 6%, which winds up being the natural rate of unemployment. We have zero inflation. If the unemployment rate is 6%, the actual inflation rate will be 0%. Also suppose that policymakers decide to use monetary policy, fiscal policy, or both to drive the unemployment rate down, which means they want to shift the aggregate demand curve to the right, right? They want to expand the economy's output, which will reduce the amount of unemployment. So let's say they want to drive the unemployment rate to 4%. So over time, the public will then come to expect a 2% inflation rate. So effectively by saying we're going to have a low unemployment rate, we're going to push it down to 4%. We're going to move along our short-run Phillips curve to that point where you have 2% inflation in order to have that lower unemployment rate. So being at that point, then people will then come to expect 2% inflation, and therefore that will shift the short-run Phillips curve. So this increase in inflationary expectations will shift the short-run Phillips curve upward to, in this case, short-run Phillips curve 2. So again, at the original point where you had 4% unemployment and 2% inflation, now you're going to have 4% unemployment and 4% inflation. So policies adopted to keep the unemployment rate at 4% will lead to 4% actual inflation rate at point B. So that is what it will lead to, due to the fact that, again, people will expect inflation to be at 2%, which will actually raise inflation by 2% at any unemployment rate. So the 4% actual inflation rate at that unemployment rate of 4% then gets built into expectations about future inflation rates. So then people come to expect 4% inflation. So the short-run Phillips curve again shifts upward to short-run Phillips curve 4. To keep the unemployment rate at 4% would now require accepting a 6% actual inflation rate. So again, this is due to like monetary and fiscal policy pushing the aggregate demand curve to the right to the point where the equilibrium output level is above potential, which means that we are in an inflationary gap, right? So there is inflation, and because there's inflation, in order to try to keep the unemployment at a certain point, people are going to expect more inflation, which will then drive policy to keep unemployment at that same level, which will then create new expectations about higher inflation, which will then again be absorbed into the process via shifting up of the short-run Phillips curve. So a persistent attempt to trade off lower unemployment for higher inflation leads to accelerating inflation over time. To avoid this trend, the unemployment rate must be high enough that the actual rate of unemployment matches the expected rate of unemployment. This situation happens at this point, at E naught, where you have 0% inflation and 6% unemployment. At that point, there are no expectations about inflation because there is no inflation at that point. The unemployment rate is high enough where that you do not lead to this accelerating cycle of inflation. When the expected inflation rate is 0% and the unemployment rate is 6%, the actual inflation rate is 0%. It's also the situation at E2 on the short-run Phillips curve 2 and the situation at E4 on the short-run Phillips curve 4. So what these points represent is a level of unemployment which we call the non-accelerating inflation rate of unemployment, which we can use the acronym NAIRU to sort of sum it up. So the non-accelerating inflation rate of unemployment is the unemployment rate at which inflation does not change over time. So keeping the unemployment rate below the NAIRU, so if you try to keep it below that NAIRU level, that leads to ever accelerating inflation and cannot be maintained. Most macroeconomists believe that there is a NAIRU and that there is no long-run trade-off between unemployment and inflation. Therefore, at the NAIRU, you will find the perfectly vertical long-run Phillips curve, which again represents the fact that there is no trade-off between unemployment and the inflation rate in the long run. So it shows the relation between unemployment and inflation after expectations of inflation have had time to adjust to experience. So it basically represents the state at which all expectations are then fully incorporated into the actual rate of inflation. So it's vertical because any unemployment rate below the NAIRU leads to ever accelerating inflation. It shows that there are limits to expansionary policy because an unemployment rate below the NAIRU cannot be maintained in the long run. If you try to expand the economy too much via expansionary policies, you're going to wind up being at a point where your unemployment rate is below the NAIRU, which will lead to accelerating inflation. Moreover, there is a corresponding point that we have not yet emphasized, and that is that any unemployment rate above the NAIRU leads to decelerating inflation. So the opposite process occurs when the unemployment rate is higher than the NAIRU level. So now let's establish the connection between the natural rate of unemployment and this NAIRU, non-accelerating rate of unemployment, inflation rate of unemployment. So NAIRU is just ultimately another name for the natural rate of unemployment. The level of unemployment the economy needs in order to avoid accelerating inflation is equal to the natural rate of unemployment. Economists estimate the natural rate of unemployment by looking for evidence about the NAIRU from the behavior of the inflation rate and on the unemployment rate over the course of the business cycle. As the final 3 months of 2014, the Congressional Budget Office estimate of the U.S. natural rate of unemployment, or also the NAIRU, the non-accelerating inflation rate of unemployment, was 5.5%. All right, let's talk about the cost of disinflation, so the process of trying to bring down the price level. So once the public has come to expect continuing inflation, bringing inflation down is painful. To reduce inflationary expectations, policymakers need to run the process in reverse, adopting contractionary policies that keep the unemployment rate above the natural rate for an extended period of time. Beginning in late 1979, the Federal Reserve imposed strongly contractionary monetary policies. As I mentioned, in the 70s, we had high inflation in this country due to the supply shocks, due to the oil shocks. So again, beginning in late 1979, the Federal Reserve imposed strongly contractionary monetary policy, which means that they contracted the money supply, which means that instead of buying bonds, they sold bonds, and therefore they took money out of the economy, and via the money multiplier process, that shifted the money supply curve to the left versus the right, which raised the interest rate, which then raises the opportunity cost of investment, which leads to less investment, which shifts the aggregate demand curve to the left. So again, during that time, the Federal Reserve imposed strongly contractionary monetary policies, which pushed the economy into its worst recession since the Great Depression. So here's 1979 through 1989. Here is the core inflation rate. The core inflation rate does not include energy prices, which are volatile, that move a lot, and food prices. So that's what the core inflation rate is. And we see that 1979 was at 10%. Right before 81, it went up, and then it started going down, and then remained pretty stable around like 4% past like 83. And then if we look at the output gap as a percentage of the potential output from 79 to 89, we see that during that period where the contractionary monetary policies were trying to bring down the price level, that we wound up with a huge negative output gap, which again, as we know, is going to lead to severe unemployment. Not a one-to-one relationship, but pretty close. And so that was very painful for everybody, essentially. Well, the poorest of us. So that is what disinflation results in. It results in us having to accept the fact that people are going to have to be out of work in order to bring prices down. So it wound up costing 18% of our annual output. So it actually contracted our GDP by 18%. Let's look at disinflation around the world. Several nations brought inflation under control in the 1980s after the oil shocks and inflation of the 1970s. It wasn't just us. Britain, Italy, they also went through the same process. So again, like, things don't happen in a bubble. We are an interconnected world. When one country is affected, most countries are going to be affected. And so everybody's going to enact the same kind of measures. Everybody has a central bank. Everybody has monetary policy. But that's one thing that kind of creates an issue for the Eurozone, because for them, because they don't necessarily have like a central monetary authority for each government. They have one for the entire region. Then they are limited in terms of what they can do within their governments in terms of monetary and fiscal policy because of it, which creates complications. So those are issues that we'll talk about a little bit more in the next chapter, actually. Practice short answer, Phillips curve. Draw the short run Phillips curve. So again, the short run Phillips curve is a graphical representation of the negative short run relationship between the unemployment and the inflation rate. So again, you would put the inflation rate on the y-axis and the unemployment rate on the x-axis. And then there's your short run Phillips curve. It's a negative line there. Which way does the short run Phillips curve move in response to a fall in commodity prices? Graph the shift. So a fall in commodity prices, what does that do to aggregate supply? So which direction is that? It's to the right. It's to the right, right? Because commodity prices have gone down. So we're talking about oil, steel, the things that firms use to produce, like the basic ingredients of production. And if the prices of those things are going down, firms are going to produce more at any given price level. So aggregate supply will shift to the right. And so what will that do to the Phillips curve? What direction? Down. It's going to shift down. It's going to shift down. But I mean, it is to the left as well, so that does work. So a fall in commodity prices leads to a positive supply shock, which lowers the aggregate price level and reduces inflation. So we have a shift to the right of the aggregate supply curve. As a result, any given level of unemployment can be sustained with a lower inflation rate now, meaning that the short-run Phillips curve has shifted downward. So short-run Phillips curve shifts downward. In contrast, a surge in commodity prices leads to a negative supply shock, which raises the aggregate price level and increases inflation. That's the opposite case. Any given level of unemployment can be sustained only with a higher inflation rate, meaning that the short-run Phillips curve has shifted upwards in the opposite case. Part C, why is there no long-run trade-off between unemployment and inflation? Demonstrate this graphically. So again, in the short run, expectations about changes in inflation will shift the short-run Phillips curve. When employment contracts are being set, expectations of higher prices in the near future will lead to higher wages. For these reasons, an increase in expected inflation shifts the short-run Phillips curve upwards. The actual inflation rate at any given unemployment rate is higher when the expected inflation rate is higher in the short run. In the long run, though, any consistent rate of inflation will be considered in expectations, and therefore you will not have that trade-off between unemployment and inflation in the long run, and so the long-run Phillips curve can simply be represented as a vertical line at the non-accelerating inflation rate of unemployment at the NAIRU. Again, the non-accelerating inflation rate of unemployment is the unemployment rate at which inflation does not change over time. And the long-run Phillips curve shows the relationship between unemployment and inflation after expectations of inflation have had time to adjust to experience. So there's no long-run trade-off between inflation and unemployment because once expectations of inflation adjust, wages will also adjust, returning employment and the unemployment rate to their equilibrium natural level. This implies that once expectations of inflation fully adjust to any change in actual inflation, the unemployment rate will return to the natural rate of unemployment, or the NAIRU, non-accelerating inflation rate of unemployment. Say that 5 times fast. All right, this also implies that the long-run Phillips curve is vertical. All right, let's talk about deflation a bit, and then that'll close out the chapter. So debt deflation. Deflation, like inflation, produces both winners and losers, but in the opposite direction. Due to the falling price level, a dollar in the future has a greater real value than a dollar today. It will be able to buy more in the future than today. Lenders who are owed money gain under deflation because the real value of borrowers' payments increases. So they have a certain amount of money that is owed to them, and that money increases in real value, and therefore people essentially are paying back more real money than they initially were when the inflation rate was higher, when the price level was higher. So borrowers lose because the real burden of their debt rises. In a famous analysis at the beginning of the Great Depression, Irving Fisher claimed that the effects of deflation on borrowers and lenders can worsen an economic slump. Fisher argued that borrowers who lose from deflation are typically short of cash and will be forced to cut their spending sharply when their debt burden rises. So that means that aggregate demand will shift to the left. Lenders are unlikely to increase spending sharply when the values of the loans they own rise. Their assets are increasing in value, so they're getting more money, so they don't really need to do anything else. The overall effect, said Fisher, is that deflation reduces aggregate demand, deepening an economic slump, which in a vicious circle may lead to further deflation. So this concept called debt deflation sort of sums up this whole process. Debt deflation is the reduction in aggregate demand arising from the increase in the real burden of outstanding debt caused by deflation. Let's talk about the effects of expected deflation. So like expected inflation, expected deflation affects the nominal interest rate. So as we talked about before, the Fisher effect, expectations of Inflation will only affect the nominal interest rate, not the real interest rate. The real interest rate is the nominal interest rate minus the rate of inflation. So again, if people expect there to be inflation, that will affect the nominal interest rate. That will cause the nominal interest rate to fall. But there is only so far that an interest rate can fall, and the lowest it can fall is its zero bound. So the nominal interest rate's lower bound is the zero bound. It cannot go below zero. This zero bound can limit the effectiveness of monetary policy. As we know, monetary policy is meant to shift the money supply in order to affect the interest rate, which affects the opportunity cost of investing, which then affects aggregate demand. So when the economy falls into this point where the interest rate is at zero, we fall into what's called a liquidity trap. The economy is in a liquidity trap when conventional monetary policy is ineffective because nominal interest rates are up against the zero bound. So zero bounds in U.S. history, we had it, of course, during the Great Depression era, and then, of course, again, we had it during our Great Recession, and we're still kind of there. So the recent history of the Japanese economy provides a modern illustration of the problem of deflation and the liquidity trap. Japan has had crazy deflation for the last couple of decades. After the 1980s housing and property boom went bust, Japan fell into persistent deflation. So here we've got their inflation rate from 1980 to 2013. We see it fall. It kind of went up a bit there in the late 80s, but still fell again and still stayed pretty low, kept falling just during this whole period. And so their interest rate also fell, and then eventually fell in an attempt to try to rebound the economy, right? You lower the interest rate, you're trying to increase economic activity, which will then increase prices, which will increase inflation. It wasn't working too well, obviously, but it did wind the country up in a liquidity trap for quite a long time. The result was a prolonged period of economic stagnation, which is called the lost decade, which gradually reduced the inflation rate and eventually led to persistent deflation. All right, so that's the end of chapter 16, folks. Again, inflation, deflation, and disinflation. All right, we have enough time to cover chapter 17. Crises and consequences. So again, this has to do with banking, so we'll talk more about banking as we have been, but we'll talk a little bit more about like the private, the shadow banking industry, as it's called. Again, dealing more with investment banks and hedge funds and money market funds. So what we're going to learn in this chapter: how depository banks and shadow banks differ. Why, despite their differences, both types of banks are subject to bank runs. What happens during financial panics and banking crises. Why the effects of panics and crises on the economy are so severe and long-lasting. How regulatory loopholes and the rise of shadow banking led to the financial crisis of 2008. And how a new regulatory framework seeks to avoid another crisis. So just a quick side note here. I was reading The Economist this week, and it talks about what we have to look forward to with Trump's presidency. So before the election, Wall Street dreaded Donald Trump as a dangerous, unpredictable, and disruptive, if improbable president. Since his victory, fear has turned to hope. Stock markets are at record highs, and shares in financial institutions have been among the best performers. Mr. Trump, it turns out, looks to big finance like good news. And the reason for that is because they're expecting him to deregulate a lot of the regulations that were set in place after the 2008 financial crisis. So partly this reflects Mr. Trump's change of tack. He campaigned as the leader of a Rust Belt revolt against the besuited, pampered elite. As president-elect, he seems less of an outsider, though. Among the rumored names he has mulling as his choice for Treasury Secretary are Jamie Dimon, who's the boss of JP Morgan Chase, which is one of the biggest investment banks, and Stephen Mnuchin, a 17-year veteran of Goldman Sachs, another one of the big investment banks. Um, so Wall Street's access to the corridors of power seemed likely to be unimpaired. But the euphoria mostly reflects the finance industry's excitement at one of the most achievable of Mr. Trump's campaign promises, and that is to cut red tape. In a YouTube video this week outlining his priorities, he announced a new rule. For every new regulation, 2 old ones must be eliminated. It's like arbitrary rule. It's like ridiculous, but whatever. No industry in America feels as browbeaten by regulators as does finance, as we'll talk about in this chapter. So the finance industry, awaits the bonfire of the rule books with glee. In this context, a speech on November 18th by Mary Jo White, the outgoing chair of the Securities and Exchange Commission, which is one of the monitoring agencies of the government that monitors like financial transactions, investments, that sort of thing. So she wrote on her way out, basically setting up. Well, she said that they were setting up all sorts of new regulations that was going to help to clear up the wreckage of the 2008 crises. In her speech, she outlined new and unrelenting model for combating white-collar crime. But she and an entire layer of Obama-appointed regulators are on their way out. By February, with the start of the Trump administration, this regulatory legacy may also be under threat, whether the celebration of large dollar settlements from errant institutions or the production of ever more rules. Defining this approach was the Dodd-Frank Act, which we talked about a couple of chapters ago, but we will talk about again today, which was enacted in 2010, which Mr. Trump has vowed to dismantle. The act is so sprawling that 30% of its 390 distinct rules have yet to be adopted, according to the Davis Polk law firm. Even executed partially, Dodd-Frank has had vast consequences. A study by George Mason University's Mercatus Center, using data up to 2014, showed that Dodd-Frank had already led to 27,669 new regulatory restrictions. This tally excluded components of Dodd-Frank too large to be quantified, such as Section 1502, which gave the Securities and Exchange Commission a role in monitoring corporate supply chains in the interest of blocking minerals from certain African countries. Dodd-Frank is so intricate that, like the institutions it is supposed to constrain, it seems too big to tame. In fact, it has 3 features that make it malleable, fragile, even. The first is that many of its rules must be implemented by agencies, which can thereby reshape them and pick and choose among them. The second is that the authority to do this is often protected from outside tampering, which is the great irony of the Dodd-Frank, says J.W. Verrett, a law professor at George Mason University, is that all that discretion can be used to limit regulation. So essentially, this is just talking about the fact that like this regulatory framework that was set up post-2008 is complicated. It hasn't completely been enacted. It's not perfect. By no means is it perfect. It's probably broken in some places because, politics like infused some of the language and therefore, caused like all sorts of weird sort of extra red tape that doesn't need to exist. But in the end, like it's something that's necessary, and that will be established in this chapter. And it's dangerous for us to play with it, I think, at this point. But apparently, that's what we have to look forward to. But let's talk about like the relationship between banking and crises and how it affects the economy in this chapter. So banking, benefits and dangers. So banking in general is a good thing, of course, but there are different types of banks. As I mentioned, there are shadow banks, which are non-depository financial institutions that engage in what's called maturity transformation, which is the main role of banks. This includes investment banks, hedge funds, and money market funds. Maturity transformation is the conversion of short-term liabilities into long-term assets. So when you deposit your money in a bank, that account is your asset, but it is the liability of the bank. But they turn that liability into loans, which are then long-term assets for the bank. So that's them enacting maturity transformation. These other shadow banks perform the same tasks. Folks invest money with them, which again is a liability for the banks because they have to pay that money back. But then they do wind up investing in assets that have long-term returns on them. Maturity transformation. So like deposit-taking banks, shadow banks are vulnerable to bank runs because they perform the same economic task. So again, we talked about bank runs a couple of chapters ago, the logic of them. When there aren't enough protections in place for depositors, if people start to get just concerned that a bank may not be solvent, be able to pay them back their initial investments, whatever that they deposited, then they'll start asking for that money. And when they start asking for that money, it starts a vicious cycle of deleveraging where the banks then have to start selling off their assets in order to be able to pay their depositors, which then further lowers the value of their assets, which then further ties their hands in terms of their ability to pay back their depositors. And that causes more paranoia, which ultimately leads to a bank run and the failure of those banks. So in this chapter, we're going to refer to normal banks as depository banks, and these other types of banks, investment banks, hedge funds, money market funds, as shadow banks. So since the 1980s, shadow banks have grown in popularity. They're not subject to the regulations such as capital requirements and reserve requirements that we talked about that banks are subject to, that were enacted via Glass-Steagall during the Great Depression era, in which we established capital requirements, which sets up a certain percentage of excess reserves they have to have beyond like their liabilities, and also the reserve requirements, which again is a certain amount of money they have to be able to pay back their depositors. And also the FDIC, the Federal Deposit Insurance Corporation, which again is the government guaranteeing depositors their money up to $250,000 for anybody that has an account at a depository bank. So that quells fears of not being able to withdraw your funds, which then halts the propensity for bank runs. But shadow banks don't have these protections. Like the unregulated trusts that set off the panic in 1907, so we talked about these trusts a couple of chapters ago, that again were initially just meant to manage like the wealth of like dead rich people, but eventually realized, we can be like investing, and then they did invest, and then people started investing in the trust, which then led to big bubbles, financial bubbles, which we'll talk about, which ultimately burst and caused all sorts of terrible ramifications throughout the economy. So like the unregulated trust that set off the panic of 1907, shadow banks can offer their customers a high rate of return on their funds. So there's definitely an appeal to depositors to put their money into shadow banks versus depository institutions because they take riskier bets and therefore they have higher returns. As of July 2007, generally considered the start of the financial crisis that climaxed when Lehman Brothers, an old financial investment bank, went under. When they fell in September of 2008, the U.S. shadow banking sector was about 1.5 times larger in terms of dollars than the normal formal deposit-taking banking sector. So it has become huge as far as like the financial sector. So let's talk about the trade-off between the rate of return and liquidity. Basically, what attracts investors to these shadow banks. There is a trade-off in general for all of us. We can either have liquidity, cash on hand, and be able to buy the goods and services we need, or we can invest that and get a return. So without banks, savers face a trade-off when deciding how much of their funds to lend out and how much to keep on hand in cash. A trade-off exists between liquidity, the ability to turn one's assets into cash on short notice, and the rate of return received on one's assets. Without banks, people would make this trade-off by keeping a large fraction of their wealth idle, sitting in safes, rather than helping pay for productive investment spending. And so banks do serve the purpose of sort of helping to sort of mitigate the need to keep your cash on hand. It allows you the ability to invest your money and allow it to become liquid quickly if necessary. So let's talk about the general purpose of banking. Banking emerged from a surprising place, a side business for medieval goldsmiths. They had a bunch of gold. They realized, oh, not everybody's taking their gold out all at the same time. We can lend some of this out because people aren't going to be asking for it all at once. So people held receipts for their gold on deposit, and these came to be used as cash, those receipts of the gold they had deposited at the goldsmiths. Depository banks today do the same thing in the form of maturity transformation. As I mentioned, people deposit their money into checking accounts or different types of accounts, which are liabilities for the banks. The banks take that money because they know not everybody's going to ask for that money at once and, loan it out. Shadow banks also perform maturity transformation, but they borrow over the short term and lend or invest over the long term. So that they take on more sort of like a risky approach to maturity transformation. They're more about borrowing money rather than having people deposit money in their account. So they will actually take out loans to finance their risky investments. So let's talk about shadow banks and the reemergence of bank runs post, this regulatory period that helped to quell the fear of bank runs in depository institutions that then reemerged when shadow banks became a big thing. So to prevent bank runs after the 1930s, the United States and most other countries adopted wide-ranging banking regulation, as I've talked about. So there's regular audits by the Federal Reserve. I mentioned that the 12 Federal Reserve banks, they are tasked with sort of auditing the behaviors of like the banks in their region to make sure that they're not that they're following the reserve requirements, they're following capital requirements, like they're not engaging in too risky of leveraging. There's also deposit insurance, as I mentioned, the FDIC, capital requirements and reserve requirements as well. Provisions allowing troubled banks to borrow from the Fed's discount window. So we talked about that, how banks can borrow directly from the Federal Reserve Bank via the discount window at the discount rate, which is the other interest rate that the Fed affects besides the federal funds rate. The federal funds rate is the rate that they're targeting when they enact monetary policy, and it is the rate at which banks provide overnight loans to each other in order to meet the reserve requirements they need. So shadow banks do not take deposits, but if lenders suddenly decide that it's no longer safe to lend in money, the shadow bank can no longer fund its operation. So they don't take deposits like from everyday folks, but obviously people do buy into these institutions. Unless it can sell its assets immediately to raise cash, it will quickly fail. Again, if they wind up in a situation where they can no longer get the loans they need in order to fund their operations. So a bank run that spreads like a contagion is extraordinarily destructive, causing depositors at other banks to lose faith, leading to a cascading sequence of bank failures and a banking crisis. So that's what happened in 2008. You had Lehman fall, you had Bear Stearns fall, you had some other firms and some other big old investment banks falling in Europe, and then there was this contagion effect. It started to affect regular depository institutions. People started to just be afraid in general that their deposits won't be safe, and fears sort of started spreading about depository banks not being able to pay back depositors even with the FDIC. So let's talk about the day the lights went out on Lehman Brothers. Every day Lehman had to be able to convince its creditors that it was a safe place to park their funds. One day it just couldn't. JP Morgan balked at taking them on without guarantees. The government refused to guarantee value. Then all hell broke loose. The stock markets dropped 504 points. Global panic set in. Within days, the government reversed course and agreed to bail out other major corporations like AIG. AIG is basically the firm that provides insurance to these investment banks. So if they were in trouble, then everybody knew that the investment banks was in trouble. But the government started bailing out agencies like AIG and would spend $250 billion to bolster banks. And of course, then everything went black essentially, and then we wound up giving them $1 trillion. Like, here you go, here's $1 trillion that we somehow have, when at other times we don't have it, when people need to be educated and whatnot. Anyway, so that's the stuff that happened. Let's do a quick practice problem focusing on maturity transformation and bank runs. So which of the following are examples of maturity transformation? Again, maturity transformation involves converting short-term liabilities into long-term assets, which are subject to a bank run-like phenomenon in which a fear of a failure becomes a self-fulfilling prophecy. Explain. So again, maturity transformation, the conversion of short-term liabilities into long-term assets. Let's just say assets. You sell tickets to a lottery in which each ticket holder has a chance of winning a $10,000 jackpot. Is that a form of maturity transformation? No, right? It is not a form of maturity transformation. This is not an example of maturity transformation because no short-term liabilities are being turned into long-term assets. Like, when you sell the lottery tickets, you're not expecting people to give them back to you, right? Like, so it's not subject to a bank run. B, Dana borrows on her credit card to pay her living expenses while she takes a year-long course to upgrade her job skills. Without a better paying job, she will not be able to pay her accumulated credit card balance. Yes. So she's borrowing on her credit card, right? So she's taking on a liability, and then she's turning that into a long-term asset, which is like the human capital that will upgrade her job, right? So it is. This is an example of maturity transformation. Dana incurs a short-term liability, credit card debt, to fund the acquisition of a long-term asset, better job skills. It can result in a bank run-like phenomenon if her credit card lender becomes fearful of her ability to repay and stops lending to her. If this happens, she will not be able to finish her course, and as a result, she will not be able to get a better job that would allow her to pay off her credit card loans. Part C. An investment partnership invests in office buildings. Partners invest their own funds and can redeem them only by selling their partnership share to someone else. Yes, exactly. This is not an example of maturity transformation because there are no short-term liabilities in this case. The partnership itself has no obligation to repay an individual partner's investment and has no liabilities, short-term nor long-term. So yes, all of you are correct. Good job, folks. D, the local student union savings bank offers checking accounts to students and invests those funds in student loans. Right, but so it's the bank, right? So the bank is taking on liability, right? The checking account, in order to invest in a long-term asset, which are loans, right? You can't think. I mean, obviously, you would naturally think about the student point of view because you're students, but you got to think within the problem. But yeah. So I mean, ultimately, it comes down to understanding like short-term liability, long-term asset. Is that happening? Are those two criteria met? All right. So this is an example of maturity transformation. The checking accounts are short-term liabilities of the student union savings bank, and the student loans are long-term assets. All right, let's talk about banking crises and financial panics. So banking crises occur when a large part of the depository banking sector or the shadow banking sector fail or threaten to fail. So let's talk about the logic of banking crises. When banks get into trouble, there's two possible explanations. One, there's been a shared mistake. Banking crises usually owe their origins to many banks making the same mistake of investing in an asset bubble. So we talked about how in 2008, like these subprime mortgages were securitized. They were made into these assets that masked the risk of these subprime mortgages. The fact that that as the value of homes would eventually drop, which they did, then these homeowners were no longer going to be able to pay their mortgages. And that means that the underlying asset in these securitized assets had no value. But banks kept doing it over the course of the 2000s, kept taking on those securitized assets as part of their assets in their T account, and eventually those went belly up. So this caused an asset bubble with respect to these securitized assets, these I hate this word, collateralized debt obligations, CDOs, which was the name of the assets. So an asset bubble is the price of an asset. An asset bubble entails the price of an asset being pushed to an unreasonably high level due to expectations of future price gains. So it happens in the housing markets all the time. People expect housing prices to go up, which is what happened also in the 2000s, which is what led to the bursting of the CDO bubble. It was the bursting of the housing bubble. People were investing in housing just because prices were going up, but eventually it became clear that people weren't going to buy at those high prices because they weren't actually worth those prices, and so then the bubble burst. Pop. So another one of the reasons that can cause these kinds of crises is financial contagion. As I mentioned, financial contagion is a vicious downward spiral among depository banks or shadow banks. Each bank's failure worsens fears and increases the likelihood of another bank failing. One underlying cause of contagion arises from the logic of bank runs. In the case of depository banks, when one bank fails, depositors are likely to become nervous about others. In the case of shadow banks, when one fails, lenders in the short-term credit markets become nervous about lending to others. A second channel of contagion involves asset markets and the vicious cycle of deleveraging that I've talked about. Talked about it in the last chapter, talked about it a little bit today. So when a financial institution is under pressure to reduce debt and raise cash, it tries to sell its assets in a fire sale, which then lowers the value of its assets even worse, which then weakens its T account even more. So other financial institutions own similar assets whose prices also decline. So combining an asset bubble with a huge unregulated shadow banking system and a vicious cycle of deleveraging, and it's easy to see how a full-blown financial panic could occur. So a financial panic is a sudden and widespread disruption of the financial markets that occurs when people suddenly lose faith in the liquidity of financial institutions and markets. Since banking provides much of the liquidity needed for trading financial assets like stocks and bonds, severe banking crises almost always lead to disruptions of the stock and the bond markets as well. So let's look at the brief history of these banking crises. The age of panic. So we had the national banking era, 1963 to 1912. Basically, the Federal Reserve Bank was introduced around this time period, which started the centralized banking era. But before that, you had these national banks that were sanctioned by the federal government, but they all kind of issued their own currency. So September 1873, the number of bank failures was 101. May of 1884, 42. November 1890, 18 bank failures. May through August of 1893, 503 bank failures. October to December of 1907, 73 bank failures. And then looking at the Great Depression era, 1929 to 1961. So November to December of 1930, you had 806 bank failures. April to August of 1931, 573. September to October 1931, 827. June to July of 1932, 283. And February to March of 1933, FDR declared a bank holiday to stop the bank runs that were occurring, to try to curtail that contagion effect. So between the Civil War and the Great Depression, the United States had a famously crises-prone banking system. Most banking was carried out by these national banks that were regulated by the federal government and subject to rules involving reserves and capital. However, there was no system of guarantees for depositors. So again, that very easy sort of widespread contagion effect of the fear of not being able to take your money out was at the center of all of these bank failures. So let's look at modern banking crises around the world. So according to a 2008 analysis by the International Monetary Fund, the IMF, again, this sort of like international agency that was created like in the 60s to lend money to countries that are in trouble. According to the IMF, no fewer than 127 banking crises occurred throughout the world between 1970 and 2007. Most of these were in small, poor countries that lacked the regulatory safeguards found in advanced countries. So the regulatory safeguards we have here, like FDIC, reserve requirements, capital requirements, you'll find them in most developed countries. In more advanced countries, banking crises almost always occur as a consequence of some kind of asset bubble. Sweden, so here's the real housing price index. So Sweden, Japan, Finland, all of them had housing bubbles that occurred throughout the late 80s and early 90s. So again, so if you think of if you index the price of housing to 100 from 85, then you can see how prices rose relative to that. In Sweden, in Japan, in Finland, and then eventually those asset bubbles burst. Between 85 and 95, 3 advanced countries, Finland, Sweden, and Japan, experienced banking crises due to the bursting of real estate bubbles. So what are the consequences of the banking crises for the overall economy? So banking crises, recessions, and recovery. Banking crises are almost always associated with recessions, and severe banking crises are associated with the worst economic slumps. So here we've got the unemployment rate. And then here we have the time periods. So T right here represents the point at which there is some sort of asset bubble bursting. So here is Sweden in 1991, post that real estate bubble bursting. Here is the United States in 2008. So we see the unemployment rate is stable before that up until the T period, the period where it actually happens. Panic of 1893, same thing. Asset bubble caused that. Post that period where it actually happened, you see that the unemployment rate rose dramatically in all 3 countries. It's not a phenomenon that is specific just to this country, to 2008. It's the nature of the way things work overall in our economy. The strict connections that exist between the health of the economy and the health of the financial sector, and just how volatile it all is, and how therefore we need to be very vigilant with respect to the behavior of the shadow banking sector, and why everything I talked about at the beginning with respect to Trump is dangerous. It's not something to be completely be afraid of, because there are other safeguards in place that will sort of control the effects of those deregulatory approaches that are going to be taken. But we don't know how much further it's going to go, though, beyond what we assume it's going to go. So you never know what's going to happen, essentially. But that's why people were nervous before, and they should still be nervous. But obviously, as mentioned, there's a very close link between the health of the shadow banking sector and the health of the stock and bond market. So if there's going to be deregulation in the shadow banking sector, which will cause greater profits for them, then obviously that's going to make people more optimistic about investing in stocks and bonds, which will then, increase the activity there. But that can easily lead to a bubble, an asset bubble with respect to stocks and bonds. So dangerous territory, folks. But whatever, let's take it one day at a time. So a severe banking crisis is one in which a large fraction of the banking system either fails outright or suffers a major loss of confidence and must be bailed out by the government. Such crises almost invariably lead to deep recessions, which are usually followed by slow recoveries. So the bars on the left show the rise in the unemployment rate during and following a crisis, and the bars on the right show the time it took before the unemployment began to fall. So again, you see unemployment rose pretty heavily. This is in all of these different countries that experienced banking crises. Malaysia 1997, Indonesia 1997, Thailand 1997. So in 1997, there was this huge contagion effect throughout all the Asian countries that were developing that seemed to be burgeoning, seemed to be growing at like great rates. They seemed to be advancing. Things were really great as far as like the optimism of investors, which brought a lot of money into those countries. But as soon as like one of them started getting in trouble, all the investors started pulling out of all of the countries, and it led to a pretty bad time period. Korea was also part of it, Hong Kong, Philippines, Thailand, Indonesia, Malaysia. Pretty bad time for all those countries. Countries that did not need to be experiencing that, because even though they were developing and were experiencing these like asset bubbles, like the people themselves weren't necessarily benefiting from that to the extent that they were being raised up. And therefore, if you contract the economy, you're just hurting a bunch of poor people more. And that's essentially what happened there. So you see that the amount of years. So this measures the amount of years that it takes for unemployment to begin to fall. Japan, you've got over 12 years. Most of these roughly, at least the Asian countries from 97, landing at about 5 or 6 years. That's pretty bad. 5 or 6 years of really high unemployment. And again, having everything to do with like the bursting of asset bubbles and banking crises. So we need to be more vigilant, essentially, ultimately. So why are banking crises, recessions so bad? There's three main reasons that banking crises normally lead to recessions. One is that there's a credit crunch. A credit crunch means that potential borrowers either can't get credit at all or must pay very high interest rates. So in 2008, right after everything went crazy, banks were not lending at all. Even after the bailout, even after the TARP was passed and the $1 trillion check was handed over, they still weren't lending. And so if they're not lending, people can't borrow. If people can't borrow, investments can't be made. If investments can't be made, then obviously aggregate demand shifts to the left, and then you have a recession. So unable to borrow or unwilling to pay high interest rates, businesses and consumers cut back on spending, pushing the economy into a recession. So the second main reason why banking crises normally lead to recessions is what's called debt overhang. So debt overhang occurs when a vicious cycle of deleveraging leaves a borrower with high debt but diminished assets. So anyone that borrows and has those kind of liabilities, if you think about the T account, like their assets wind up dropping in value, but their loans wind up remaining in value, and therefore they have that debt overhang that then doesn't allow them to be able to engage in investment and consumer spending, which is what we need to obviously get out of a recession. So this also leads to a fall in spending and a recession as consumers and businesses cut back in order to reduce their debt and rebuild their assets. And finally, of course, there is the loss of monetary effectiveness. So the monetary policy eventually loses its effectiveness once we hit that liquidity trap, once we hit that zero lower bound. So the ineffectiveness of monetary policy makes banking crises, recessions especially severe and long-lasting, because again, you're taking away one of our main policy tools, the monetary policy, our ability to shift aggregate demand via our increase of the money supply. And we've already talked about how we can't keep using fiscal policy to try to improve the economy. That's just not sustainable. So in the aftermath of a banking crisis, uh, banks, fearing runs by depositors or loss of confidence by their creditors, tend to hold on to excess reserves rather than lending them out. So that's the credit crunch. Businesses and consumers finding themselves in financial difficulty due to the plunge in asset prices may be unwilling to borrow even if interest rates fall. As a result, even very low interest rates may not be enough to push the economy back to full employment. Also, all historical episodes when the government fell into a liquidity trap happened after a banking crisis. So governments step in, realizing that these banks play such a crucial role in the health of our overall economy. Before the Great Depression, policymakers rarely intervened during banking crises. The catastrophe of the 1930s changed that. Now policymakers use three main strategies to protect economies from the harm of banking crises. There's one, the lender of last resort. As we mentioned, the Fed can directly lend money out. The lender of last resort, an institution, usually a country's central bank, that provides funds to financial institutions when they are unable to borrow from the private credit market. So the central bank then, which normally does not lend to these shadow banks, winds up lending them money, which is what happened post 2008. The Federal Reserve bought a bunch of those CDOs, those worthless assets, took them off the T accounts of all of the financial institutions that held them, and then that caused a little bit more confidence in the health of those remaining shadow banks. So in 2008, total borrowing from the Federal Reserve surged to 14 times the level before the crises. Another thing the government can do is offer government guarantees. So if the public believes that the bank's assets aren't worth enough to cover its debts, even if it doesn't have to sell these assets on short notice, a lender of last resort isn't going to help much. In such cases, governments often step in to guarantee banks' liability. So then they do step in and say, well, even though there is no FDIC for these shadow institutions, we will guarantee their liabilities so that people don't start trying to withdraw their funds from them. Essentially, all the lenders trying to get their money back. Sweden seized a large part of its banking system in 1992. Britain nationalized Northern Rock in 2008. In the U.S., the FDIC, the Federal Deposit Insurance Corporation, seized 140 banks in 2009. So when governments take on banks' risk, they often take ownership of the banks they're rescuing, an action called nationalization. So they'll nationalize these risky banks, and once they get them under a state that is a little bit more healthy and people can be a little bit more confident of, then they'll sell these private institutions back to the public. So they'll nationalize them temporarily in order to stop the contagion effect, stop the likelihood of there being a bank crisis or further bank crises. So these government takeovers are almost always temporary. And finally, the government can provide direct financing. So during the depths of the 2008 financial crisis, the Federal Reserve expanded its operations beyond the usual measures of open market operations and lending to depository banks. It also began lending to shadow banks and buying commercial paper, which are short-term bonds issued by private companies. So we know the government issues bonds in order to expand the money supply, in order to fund some of its activities. But obviously companies can also issue bonds. Private companies can issue bonds. When they issue bonds and they're borrowing money in order to engage in R&D, research and development, to develop a new product, whatever, those bonds are called commercial paper. So again, in 2008, the federal bank began lending to shadow banks and buying some of that commercial paper, those short-term bonds issued by private companies, as well as buying the debt of Fannie Mae and Freddie Mac, the government-sponsored home mortgage agencies. The Fed provided credit to keep the economy afloat when private credit markets had dried up. All right, a few last words about the 2008 crises and its aftermath. Severe crises, slow recovery. So as we know, we had a pretty rough time in 2008. So here's our real GDP over this time period, 2007 to 2014. fell dramatically during that time period. Also in the Eurozone obviously experienced the same effects because they were actually experiencing the exact same thing. They had the same kind of asset bubble with respect to real estate, with respect to CDOs. It all kind of happened at the same time for all of us. So that's why it was even more severe than it would normally be if it was just contained to one country. Because we are so interconnected now, the behavior of basically all of the behaviors of these like large financial institutions and large investors is not specific to any one country anymore. It's a very international phenomenon now. Money is not money is international. Money has nothing to do with an individual country. So in the U.S., fortunately, we have rebounded. The Eurozone is kind of still stagnant though, and this whole Brexit thing hasn't helped them much. By 2011, almost half of all unemployed Americans were long-term unemployed. So here's the unemployment rate. That's the orange one. And then the yellow one tells us the long-term unemployed for 27 weeks or more as a percentage of all unemployed. So we see that before 2008, that percentage was small, but that became pretty large and still is up until today. Again, you have a lot more people out of work for a lot longer. Still, now, 6 years later, as a result of this crisis that happened in 2008. Aftershocks in Europe. So the 2008 banking crisis wasn't confined to the U.S., as I mentioned. At first, investors lost confidence in banks about private debt. Then in 2011 through 2012, it turned to public government debt. So you had these other countries like Italy, Spain, Portugal, Ireland, Greece. People started getting worried about their ability to pay back their debts, which is like, pay back what they owe on their bonds that they issue. And so as a result of that, they had to start paying really high interest rates on those bonds, which then put them into even more dangerous territory because they had to borrow more money in order to pay not only their normal fiscal needs, but also, that extra interest that they are now having to pay on the bonds. So Greece was the first, then Spain and Italy. As governments cut their budgets, the recovery faltered, further spooking investors. So the interest rate spread between two countries is a measure of their perceived risk. So again, the higher the interest they have to pay on their bonds, the riskier that investors perceive those assets. So this is the interest spread against the German 10-year bond. The Germans were fine. Nobody was afraid of the German bonds not being able to be paid back. So we see that relative to the German bonds, Italy and Spain wound up having to pay huge amounts of interest. And again, it all reflected the fact that there just was no confidence in their government solvency, their ability to pay back their debts. And it had a lot to do with the fact that they are in this currency union and that their monetary policy was basically neutered by giving up that to the central currency authority. Okay, so during this time there was this sort of debate about whether or not the best way to approach these situations is to provide stimulus, which is to, again, have the government spend money, engage in fiscal expansionary policies in order to try to expand the output of the economy. But some believe that the best approach is to just cut back on everything, cut back on the spending that governments engage in with respect to like social programs and things of that sort, which is what's called austerity. So policymakers were divided. The question was, did the situation call for fiscal stimulus, expansionary measures like government spending, or tax cuts to promote spending and reduce unemployment? Advocates of fiscal stimulus focus on the continued high unemployment and argued that a quicker return to economic health will naturally reduce budget deficits. But then the other side of the coin was those that were proponents for fiscal austerity, which are contractionary measures like spending cuts or tax increases to reduce budget deficits. So advocates pointed to Greece's budget woes and worry that more stimulus will cause similar outcomes in other countries. So in Greece, they felt that like because there was so much public spending on behalf of the government that by providing them fiscal stimulus, that's just going to give them an excuse to spend more um, and put them further into a hole. And so the advocates believe that they should cut their spending and that would be the better approach. So by 2014, the intellectual debate seemed to have gone mostly against the advocates of austerity. Austerity was sort of like the trend up until this time period, but then it did become obvious that austerity actually winds up hurting countries more than helping them during these like intense periods of economic contraction. So research by the IMF, the International Monetary Fund, supported warnings that austerity policies depress output and employment, especially when there's little room for interest rates to fall. The shift in the intellectual debate did not, however, lead to much change in actual economic policies. All right, and finally, regulation in the wake of the crises. In 2010, Congress enacted the Dodd-Frank Bill, the Wall Street Reform and Consumer Protection Act. Its main elements are one, to create what's called the Consumer Financial Protection Bureau, so consumer protection. It's dedicated to policing financial industry practices and protecting borrowers. So that's part of all those regulations that were mentioned in that Economist article. Obviously, when you create a lot of red tape, you're going to create maybe too much red tape. And it is on the verge of that, if not already in that territory. But still, the intention, obviously, is right. There's also derivatives regulation, require more transparent trading. So like with those CDOs that were securitized, packaged subprime mortgages, where the people that were buying and selling them really had no idea about how risky the assets were. The derivatives regulation is meant to create transparency with respect to that process, so that it becomes clear what you're actually buying, what these securitized assets are actually backed by, and the amount of risk that they might carry. It also included regulation of shadow banks. Again, define whether a bank is systematically important and capable of creating a crisis. If so, regulate. So if some of these shadow banks are too big to fail, we've heard a lot of this catchphrase over the last 6 years, too big to fail. If some of these banks like JP Morgan Chase or Goldman Sachs, which are too big to fail, if they are deemed of that nature, therefore they are subject to more regulation, which is what the Dodd-Frank bill enacted, which is what Trump is going to undo, partly, maybe completely, who knows, we'll see. And then a resolution authority, which gives government authority to seize control of any failing financial institution. So these are regulations that are necessary. I think we've tracked the story in this chapter of how important this financial sector is, the shadow banking sector, how large of an impact it can have on an economy. And given what you understand about the economy, all the connections that exist in the macroeconomy, how important it is for us to regulate them. All right, folks, we are done with this chapter. Congratulations, you made it through 2 of the last 3 chapters that we're going to cover. So next week we'll cover open economy, macroeconomics. I'm glad I wanted to get through these 2 chapters because that chapter itself is kind of like its own world. So I wanted to just focus on that. So we will have a chance to do that. Have a great week. Work really hard. Don't relax too much. You're going to relax for 5 weeks during the break. Work, work, work. Anyway, have a good one. I'll see you.